Now, currently under GAAP, if an organization has what we call today a permanently restricted endowment fund or a perpetual endowment fund, and the fund loses money, it goes underwater. And the definition of an underwater endowment is simply the fair value of the assets underlying the endowment is lower than the original principal or corpus, or the amount required by law to be kept in perpetuity. So for example, simple example, an organization receives $1 million contribution. The donor says this is a permanent endowment fund or a perpetual endowment fund. They invest the money prudently, and the market drops. So next year it's only worth $900,000. That endowment is $100,000 underwater. And what current GAAP says is that the organization would still reflect $1 million in the permanently restricted class and a negative $100,000 in the unrestricted class. New standard, what that says is the $900,000 endowment fund balance will be classified in net assets with donor restrictions. Now, this is the first of the two accounting changes I alluded to before. This is an accounting change because it might require a journal entry. In the example I just brought out, that organization on January 1, 2018 would have to take that negative $100,000 out of net assets without donor restrictions and put it into net assets with donor restrictions. So we're actually going to debit net assets with donor restriction, credit net assets without donor restrictions for $100,000. That's why it's considered an accounting change. There are also going to be some more endowment disclosures. Now, there have always been certain endowment disclosures, but now the organization will be required to disclose in the aggregate for all endowments that are underwater, meaning we're going to take all the endowments underwater, which might be 1, 2, 3, 4, but not necessarily all the endowments. Add them up, disclose the fair value of the endowments that are underwater in the aggregate, the amount required by the donor or law to be kept intact, the underwater amount, which is simply the subtraction of A from B, and any board policies or actions taken to spend or expend money from underwater endowments. Under UPMIFA, that's the law, and it's effective, as I mentioned, in 49 states. An organization may actually spend money from an underwater endowment, so long as the board appropriates it for expenditures and follows the 7 or 8, depending on what state you're in, factors that the board needs to consider and document that they considered to prove prudency in their expenditure policy.